Hi, this is Roger Conrad, editor of Utility Forecaster, Canadian Edge, and New World. What I want to talk to you today about are a couple of issues, one being involving with the broader market. The story right now, I think, that you see in the financial media rather consistently is, or the big question being asked rather, is what we're seeing now a bear market rally, or is it the start of a prolonged recovery? And I think pretty much the consensus is that this is a bear market rally. I mean, people are sort of disbelieving. Obviously, it's kind of the news in the economy continues to be somewhat negative. We have various problems afflicting the new administration, for example, regarding the AIG bailout, which occurred actually under the last administration's watch, but now we're seeing the current administration blamed for that, which is, that's all about politics, but it's also, I think, contributed to general sense of gloom in the overall marketplace. If you look at investor surveys, which again are an inexact indicator, but we're pretty much near historic lows across the board, no matter whose survey you might be looking at. In other words, the level of investor pessimism is historically high. Obviously, that's what you'd expect when you see the S&P drop, more than in half, basically, over a 6-month period. So there's lots of reasons for the pessimism, but we are seeing a tremendous amount of pessimism in the marketplace. I'm not a mind reader. I don't really like to forecast bottoms and tops in markets. Even if you talk to some of the most experienced traders out there, they'll tell you that you're only going to bottom tick or top tick a market once in your lifetime. So most of us are really better off just kind of looking for the general trend. I think a lot of people are very comfortable with the idea that you stay out of the market until there's a defined trend going up. I mean, a lot of people have pulled in their horns, sold everything, and basically are on the sidelines waiting for some sort of definitive sign that the market's going to pick up. History shows us that really does never happen. I mean, by the time that there's some definitive sign that markets have picked up, it's really it would certainly be too late to play a bear market rally, but even pretty late in the game for even if we have actually seen a turn in the market. So I think what people really need to keep in mind is that investors is that you want to continue to hold good positions in good companies. You probably want to hold a little bit of cash, and in fact, cash hold in proportion to what makes you feel, solid. But the idea that good companies do weather bad markets and do rally and are the first to rally when things turn up is pretty much the way of the market. So you don't really gain a lot by selling out, I think, at this point, provided that what you own is in good shape. Now, what are some of the broader themes, is there any room, any reason to be optimistic and not to believe that we're heading into prolonged depression? Well, one reason I think to be optimistic is the fact that deflation seems to have at least abated for now. We saw a positive CPI number, and normally that's not something that we cheer for, but in this case, it's a definite sign that there is some pricing. Some firming of prices, and of course we'll have to see how things are going forward, but that's a positive thing. Probably more positive than that is the fact that credit markets seem to have stabilized quite a bit, particularly for stronger credits. We're seeing an enormous amount of bond issues undertaken by utilities, and in the past month or two. The higher rated companies, the A-rateds, the triple-B rateds and higher, the spreads between what they have to pay and treasuries have now contracted to 200 to 250 basis points in that range, which is a little higher than what it was before the financial crisis broke, but it's considerably less than what we saw 2 or 3 months ago in the heat of the credit crisis, when the spreads were 500 basis points and even more. And if you combine that with the fact that the benchmark rates, for example, the 10-year Treasury note is now back down around 2.5%, thanks to some Fed buying of Treasury securities, then you're talking about very, very low rates that these companies are now able to borrow. So just in the same sort of principle that well-heeled or low debt or good credit risk mortgage owners or homeowners are now able to roll over mortgages at much lower rates than were out there just a few months ago. So are highly rated utility credits now able to sell debt pretty much at will and at pretty low interest rates. And again, these are market set rates. So the fact that they're not having to pay a big premium is a function of the fact that investors are willing to pay much lower premiums to get those bonds. Even the higher higher yielding or lower credit quality utility debt is also being offered at much lower rates. At the height of this crisis, we were seeing some high junk bond or low rated companies paying as much as 1,000 basis points or even 1,500 basis points more than Treasuries. Now those spreads are down in some cases as under 500 basis points. So again, sounds like a lot of technical jargon, but it just means lower rates. Companies are able to borrow, and that's of course very, very bullish for the economy. So these are the fact that the credit pressures are lessening, the fact that we've had strong fourth quarter earnings are very good signs for the utility side of the market. We still have very low prices, but again, I think this is a very strong harbinger of stronger things lying ahead, and in fact that the basic businesses of these companies are holding together. Again, a very good argument for continuing to hold strong companies, and not just in the utility industry, but across a wide spectrum. So again, just to recap, I think there are some signs that, at least on the sentiment side, that things have become so gloomy that these are at least conditions that in the past have foreshadowed bottoms. We're seeing some fairly decent news now coming through in the economy as well, although it is overshadowed in the financial media by the bad news story. And of course, certain companies are really doing far better than they were several months ago, and the credit crisis for the utilities has really dissipated. And again, at the same time, earnings have remained fairly solid. So the bottom line is to continue to hold good companies. We may have a few more months left of this bear market. We may even retest and go to significant new lows. We may see that 600 in the S&P, that 6,000 on the Dow that a lot of people were talking about a few weeks ago. But at this point, good companies have weathered quite a bit, and they're trading at huge or very, very low valuations based on historical standards. And these are very good signs, and in the past, pretty surefire signs that you need to continue to hold good companies. So that's all I had to say today. Thanks for tuning in. I'll look forward to speaking with you next time.